All right, good day, students, and welcome to another session of financial management. Now, let's get straight into it. The agenda for today is to complete the handout on inventory management, and there are a few illustrations I need to run through with you, and a few discussions. And having finished that, hopefully in a short period of time, the remainder of the lecture will be spent looking at receivables management. Now, I know I had mentioned in the last presentation that we'll be looking at cash management, but I thought it fit to do receivables management first, because I think it would be easier for you to appreciate certain things if it's done that way. Also, receivables management is a length, it's quite a lengthy area. So, I prefer to get that out of the way. I mean, it really doesn't matter at the end of it all because all of the different elements of working capital must be completed. But back to this handout. Towards the end of the last class, okay, I think the last illustration we went through was this one. Yes, which was fairly straightforward EOQ. And what I need to run through with you now, the effect of bulk buying discounts. Okay, and that's what I've got on the handout. Now, if a company gets a bulk buying discount and you need to calculate the economic order quantity, then the bulk buying discount has to be taken into account. The bulk buying discount will normally reflect itself, okay, in the fact that the company would get a discount on a per unit basis if it decides to buy a minimum quantity from the supplier. This is beneficial for the supplier, obviously, because it means he can sell more in a shorter period of time. The company has to consider, though, if it has to buy more, a minimum, it may have to purchase an amount which is higher than the EOQ. And if this is the case, it also has to recognize that the storage cost may go up. Now, the ordering cost may go down if the order size goes up, as we saw previously, but the holding cost may go up. So all these things have to be taken into consideration. The other thing is this. Usually when we are calculating the economic order quantity, in order to find the EOQ, there's really no need to consider the purchase price. And to calculate the total cost, we normally just add the holding cost and the ordering cost. I told you if the question wants you to include purchase cost, that would be indicated. However, when a bulk buying discount is being given, the examiner may ask you to determine whether the bulk buying discount should be taken. Now, since the purchase price would now be different, because clearly the buyer is getting a discount, what you'll now need to do is to calculate the total cost without the discount, that is using the EOQ. The total cost will include holding cost, ordering cost, and you must include purchase cost now. The reason being because against that total, you'll have to set off or compare the total cost with the bulk buying discount. And of course, the total cost with the bulk buying discount means the purchase cost will be different. So you're going to have to compare the two and advise. Sometimes the question may actually give you more than one bulk buying discount options, meaning if a minimum of say 5,000 units is bought each time, the discount might be 0.5%. If on the other hand, 10,000 units are purchased each time, discount may be 1% or something like that. So you have to be able to work out those things. Usually the starting point is with the EOQ. It's based on the assumption that the company may be using the EOQ right now. Let's take a look and see. Discount may be offered for ordering in large quantities. If the EOQ is smaller than the order size needed for a discount, company must calculate if the order size should be increased above the EOQ, which is what I was telling you. The total inventory cost for the annual level of demand, including holding, ordering, and purchase, should be compared. Right, this is what I mentioned. Now you must include the purchase cost. Firstly, assuming the EOQ is used, then assuming the order size enabling the discount is used. So for each of those options, you'll compare the total of holding, ordering, and purchase cost. The assumption is that the company would accept the discount and order in the larger quantity if the overall inventory cost is lower. That's why we need to compare. See, because as I said, you've got a lower purchase price than what exists right now, but you may have a higher ordering size, which means your holding cost would tend to go up. Against that, your ordering cost may come down because you would need to place less orders for the year. Bulk buying discount may be available if the order quantity is above a certain size. To calculate the best order quantity, then we need to calculate the EOQ in the normal way and the cost as noted above these three things. Calculate cost at the lower level of each discount above the EOQ, then choose the lowest cost option. We have an example here. Demand is 100 units per month. Purchase cost 10 pounds. Ordering cost 20 pounds. Holding cost is 10% of the stock value. Now, this is also important. See, when doing calculations, which request that you calculate the total cost, remember the holding cost per unit is, if it's given as say $2 per unit, it's $2 per unit. And whether the EOQ is used or some other order size, we assume the holding cost will be $2 per unit because it's per unit, remember. The way we calculate the total holding cost for the period is to take Q over 2 times CH, the average of the order size multiplied by the holding cost per unit. So whilst a bigger quantity would naturally mean a bigger holding cost in total, and a smaller quantity would naturally mean a smaller holding cost in total. Things may be a bit different if the holding cost is tied to the stock value. Now, I did mention to you, and I think it was in the handout somewhere, that holding cost may be given as a per unit cost, or it may be tied to the purchase cost. So for example, you may be doing a question told holding cost is 10% of the purchase cost. Now, what that means is that under the current system, the purchase cost is the same regardless of the order size. But if there is a bulk buying discount situation now, the new purchase cost would obviously be lower than the existing purchase cost. And it means now, in calculating your holding cost, total holding cost for each option, on the one hand, you'll have to take the percentage of the current purchase cost, and of course, work up the total holding cost. And then with the discount, you're going to have to take the total holding cost based on the discount to be given, the 10% of the new price then. So that you need to look out for. You can't simply assume that holding cost per unit would always remain the same. So demand is 100, purchase cost 10, ordering cost is $20. Okay. And required. Calculate the minimum total cost with a discount is 2% given on orders of 350 units and over. Now, when you're doing a question and you see 350 units and over, or a minimum of 350 units or 400 units and over, whatever, what you normally do is you would have to use some figure to work out your holding costs and whatnot. And in that case, what you'll do is you'll use the figure given, like the 350 or the 400 or what have you, as seen in this illustration. So the economic order quantity in this question is the square root of 2 times 20 over 1200 divided by 1. Okay, I guess I could have put some brackets there to make this thing a little better. Okay. Oh, I forgot this is a PDF presentation. Okay. But you know how to calculate the EOQ by now, and it works out to be 219. With that in mind, the ordering cost, okay, per order times annual demand over order amount. Remember, in order to calculate the total ordering cost, you take the total demand divided by the size of the order and multiply by the cost of placing an order. So 20, okay, the cost per order is $20 as given, times 1200 over 219. 1200 is the annual demand. Remember, you always work on an annual basis, 100 units per month, so don't make a mistake and use the 100. Remember, the holding cost is normally per annum. So if you work on a per annum basis with the denominator, on a month basis on the numerator in the formula, then clearly it will be incorrect. I told you that we usually have a percentage, which is normally, percentages are normally given per annum, and therefore you need to adjust the demand. So ordering cost, holding cost, as expected, both holding and ordering costs would work out to be the same as long as we are doing a typical EOQ question. Apart from if I told you if and we saw this in the last question that we looked at on the worksheet. If your square root works out to be a bit of a, okay, uneven figure, in other words, let's say it works out to be 219.67 or something like that. Now, of course, you will give your answer as 220. But the problem is when working out the ordering cost and the holding cost, there may be a slight difference between each. And that has to do with the way in which it's worked out, you see. Because, if you round this when it actually works out to be a different figure, okay, obviously it means that your answers would come back to be a bit different, okay. But that is minor. Let me just show you something to make sure you're on about this. See, like this question here, okay, 10,000 times 12. And I told you that it's, it wasn't this one, where was it? Because we had worked out the total holding and ordering cost. I wonder where it is. I want to say. Yeah. See, like in this one, okay, this worked out to be 3162, which was not actually 3162. This figure, when you work this, didn't come to exact 3162. It was adjusted. And with that in mind, when you work out these things, although you may use average stock here based on the EOQ that you use in there, when you come to calculate this, if you were to divide the total demand by 3162, there'll be a slight difference in the cost. And that is what I meant just now when I referred to it here. So anyway, in this question, obviously it's seemingly the square root was an exact figure, as evidenced by the fact that the holding and ordering costs, okay, work up to be the same. Now, the purchase cost, 10 by 100 by 12, okay, which is what it is now. 10 by 100 units a month by 12, the total purchase cost right now is 12,000, and therefore the total cost 12,220. Now, if we do the calculations using a order size of 350 units, which is the discount, okay, amount. Ordering costs would now, remember, we are using 350. So 1200 divided by 350 to get the number of orders multiplied by 20, 69. Now notice the order cost up here was 110. As expected, the order cost will fall because the order size goes up, so less orders to be placed. The holding cost, however, up here was 110. Notice the holding cost here would be more because now the company has to hold more stock at any given point in time. And once again, we are using the 350 divided by 2 to get the average stock. Okay, the holding cost per unit is, well, it was a discount at 10%. Okay, as seen here. Sorry, a discount at 2%. So £1 is the current holding cost. 98 pence will be the new holding cost. So 0.98 times 350 over 2, 171.5. Now the purchase cost will fall. Remember, right now the purchase cost is a dollar a pound. It will go to 98 cents, a discount of 2%. And the total cost works up to be 12,000, which means, as I have here, the difference of 220 suggests that the discount is worthwhile. So it's, really quite simple. Clearly, with the discount being offered, the company should take it and order 350. Now, and there's a question here on that. Okay. Now, this question is a good practice question because you've got a 2% discount is available for orders of at least 5 and a 2.5% for orders at least 7,500. Calculate the EOQ ignoring the discount and then determine if it would change once the discount is taken. Now, there are two possible discounts. This can be part of a exam question, really. Maybe one of the longer question, the constructive type question. But the EOQ is this. Step 2, as this is below the level for discounts, calculate the annual inventory cost. That's $37.95. Then step 3, we calculate total inventory cost using the order size to get the discount. And 5,000 total cost, okay, given 4,200. And here, okay, 7,500, doing a similar calculation to what was done down here. Okay, just using the 7,500. By the way, notice in this illustration, okay, the the holding cost is the same right through, because as opposed to the question we just looked at on the handout, where the holding cost would have changed because it was a percentage of the purchase price. In this question, you were just told it's 120, which makes life easier for you calculation-wise. So 5,300 is the total holding and ordering cost. Extra cost of ordering in batches. Now note how this is worked out. You could have worked it out in different ways. You could have simply found the total cost here, as I instructed on the handout, found the total cost here, okay, meaning holding, ordering, and purchase, and find it how it is at present. Just compare the figures. Or you can use an incremental approach. The extra cost of ordering in batches of 7,500, okay, is 53 minus 4211. Less saving on the extra discount. So remember, this one was 2.5, this was 2%. So that works up to be 300. Net additional cost 800. So a further cost saving cannot be made on orders of 75. The company should therefore opt for buying 5,000 units in order to maximize the discount. Now, Because what the question asks, calculate the EOQ ignoring the discount and determine if it will change once the discount is taken into account. If step 1 produces an EOQ at which a discount would have been available and the holding cost would be reduced by taking the discount where CH is based on the purchase price times the cost of finance, the EOQ must be recalculated using the new CH. Well, because remember, as I told you, the holding cost could be tied to the purchase price, as we saw in the handout illustration, but here it wasn't. Now, just to show you, okay. The current, let me just put this here, illustration. Yeah, so the current cost is $2 and it's 30,000 barrels per annum. All right. So and the holding cost on ordering cost, I'll just put the total 3794. Oh, okay, since I set it up like this already. 1897.2. And this one, 1897.53. And this gives us a total of 63,794.73. Okay. Now, to compare that with the we already determined that the 7,500 was out, so we compare that with the 5,000. All right. Okay, so we had here holding cost was 3,000 and ordering cost 1,200. Purchase cost it was 60,000, 3,000 times 2, and the discount here, you may recall, was 2%. Right? So 30 times 2 times, sorry, times 0.98. Okay. So that's 60,000 times 0.98. Okay. $58,800. That gives us 63,000. So what that means is that the current, the company would be strongly advised to take the discount as evidenced by the fact that the total cost is less than the current EOQ. And we already said the total cost here is also less than if the 7,500 is used. So you may prefer to do it like this. For each of the options, just compare purchase, holder, and ordering and compare them and, do what has to be done, right? Okay, now let us go back to this here. So this diagram actually is a representation of the requirement for safety stock. And if the assumptions of the EOQ strictly apply, then really there's no need for safety stock. I'll tell you why. Because some of the assumptions of the EOQ are as follows. Demand is known with certainty. Lead time is constant, or best case scenario, 0. But even if it's constant, it means that anytime, okay, goods and order is placed, it would be received in the specified time, say 3 days. So all that means is that the order must be placed 3 days before stocks run out. And an additional assumption of the EOQ, which is not only that demand is known with certainty, but also the demand for the material is at or the product or whatever it is at a constant rate. So which means if customers demand 200 units a day, it will always be 200 units a day. So if suppliers take, say, 3 days to deliver, the company simply needs to order when 600 units are in stock. By the time it runs down, because the rate of usage is constant, the goods will arrive. So the assumption lead time is 0 or constant, demand is known with certainty, and usage is constant on a daily basis, say, and all that adds up to is really there is no need to hold safety stock. However, that having been said, okay, a company may still wish to hold safety stock, or at least in a question, you may still encounter the need for safety stock, in which case you have to know how to deal with it. And just reading here, if lead time is 0 or constant, then it is not necessary to hold safety stocks if demand is constant, since the order is placed at the following time. Lead time in days time, daily constant demand. As the stock is used up, new stock arrives. Okay, and this is what you've got. Order placed, order arrives. Okay, and this here is the time period, the lead time. And if the order is placed here when there are 600 units in stock, okay. So this here is say 600. Sorry, this here, okay, the reorder level. And at this level, okay, and then goods arrive, the order arrives, and the difference here represents the lead time. Okay. Now, consider this. If there is no safety stock held, there'll be no gap here. However, if the company chooses to hold a safety stock, this gap here represents the safety stock. It means, therefore, that the order would be placed, assuming the same 600 usage in 3 days at this level, okay. And it means the stock level here would be the 600 plus whatever is held as safety stock, which means that the order may be placed, let's say, at the usage over the period 200 plus what the company wants to hold as safety stock. If the company desires to hold 100 units at safety stock, it means this level here would be 700 units. 700 units, okay, order is placed. This point, after 3 days, 600 units come in. At this point, 100 units remain, okay, and that is the safety stock which is always held. If there was no safety stock required, this reorder level, okay, need not be placed at a level where there is safety stock remaining. Okay. Now this here, you need to be careful about, because if you are doing a question, the examiner may ask you how, give you certain things, and you need to know how to interpret the different levels and so forth. All right, what is what and so on and so forth. Okay. Because this diagram can be interpreted in different ways according to whether there is safety stock or no safety stock. You have here difference between time order is placed and when it arrives, okay, is the lead time, which would be maybe 3 days, 4 days, what have you, okay? Now, more importantly, which is what the examiner, because you're not going to be asked to draw a diagram, but as I've been saying, he could give you one and you may be asked to see what certain things are. But more importantly, you need to know how to do the calculations related to safety stock. And the only difference really is with your holding course, because the ordering course and all that would be the same. The reason is because all the assumptions of the EOQ continue to apply. And it is assumed that the starting situation in a question, the company already has safety stock. Yeah, so it's not as though you're going to have to buy up the extra safety stock and hold it for the first time. So if, for example, the safety stock is 50 units, the 50 units are there already. It was purchased at some time in the past. So the effect, therefore, is on the holding course, because although it was purchased in the past, remember, it's been held. The only difference, therefore, would be an increase in your holding cost because of the safety stock. And in order to calculate the holding cost with the safety stock, you don't take an average of the safety stock. You take an average of Q over 2, because Q represents the quantity that you've actually bought. And remember, it's always being used. So that's why we use the average concept. But the safety stock amount is always there. Now, obviously, physically, the safety stock units would be utilized, meaning that not the same units bought 1 year ago would still be there, but 50 units would always be there, which would obviously mean that the units used up would be replaced by incoming units. So all you've got to do is to increase your holding cost. That's it, unless something else changes in the question. For example, the question says that there's also bulk buying discount included, in which case you're going to have. Right. So let's see if we got one here. Oh, there was a slight interruption just now. I don't know what caused it. Let me just check on something here. Okay. But I think we lost the electricity for. Okay, so this is the effect, the bulk buying discount, which we looked at before. Hang on a sec, let me just see. Okay. It doesn't seem as though I've got one here. All right. Yeah, so we've got one here. Alpha Company has an annual demand for its product of 100,000 units. The ordering cost per order is $50. The cost of carrying one unit of stock for the year is $3. Sorry. Demand is assumed to be constant, and so too is lead time. Safety or buffer stock equivalent to 3 days worth of demand is held. Now, what it means, therefore, is you're going to have to work out what the safety stock is, and that's easy. Remember, we said that one of the assumptions is that demand is constant. And even if the question didn't state that, you will normally assume that 100,000 divided by 365 days, okay, multiplied by 3 would give you an idea as to what the buffer stock is. And as I said just now, a few minutes ago, that's the only difference related to the calculation. Of course, don't expect now that the holding and ordering cost will be the same. Anything which distorts the straightforward assumptions of the basic EOQ model would mean that the holding and ordering cost will not be the same. And you saw that with bulk buying discounts. So here, EOQ works out to be 1,826 units. The annual holding and ordering cost would be 2739. Q over 2 times 3 is 2739. Notice the holding cost, okay, I have it in red because it would not be the same as ordering. Average stock held as usual, which is Q over 2, times CH, and the CH is $3. So I could have done it separately, 1826 over 2 times 3 plus 822 units times 3. Or, this is the easier way to go, 913 plus 822 times 3. Now, the 822 is the 3 days worth of stock. See, 100 divided by 365 times 3. And you do not apply the average to the 822. You don't say 822 divided by 2. Because I said 822 means that's the amount of units which should always be there. Okay? Right. So that would take care of the safety stock and the this bulk buying discount scenarios, which would change things. Now, the handout then goes on to discuss the just-in-time systems, okay, which I'll leave it for you to read through. And then there's this wonderful article. It was a whole article since from 2004, probably way before any of you all decided to do ACCA. But it's a great article still. At that time, the management accounting paper in level 1 was called paper 1.2. And I don't know if this was done on purpose, but the financial management paper in the level 2 was paper 2.4, which is 1.2 twice. Anyway, at that time, though, the financial management paper was not financial management alone. It was actually a mixture of financial management and management accounting. It was quite a challenging paper, actually. So this article here, very much relevant to you. Okay, it covers a lot of things which we were looking at. And I would strongly suggest that you go through it. Okay. I embedded it in the main handout, so you don't have to go looking elsewhere. It's here. Hang on a bit. Oh, well. There's some additional information here for you to read through. Please make sure and read it through. Now, there's one other thing though, which I think I need to show you. You may encounter in your EOQ questions the issue of probabilities, where you may have to use probabilities. Now, let's take a read here and I'll explain further. Alpha company is uncertain. Of course, the use of probabilities imply uncertainty. It's uncertain as to the demand level for the upcoming period. The following probabilities and associated demand levels have been derived from past information. Demand level could be 80,000 with a 50% chance, 100,000 with a 30% chance, and 120,000 with a 20% chance. Now, before we go further, thing is, if we need to use the EOQ, assuming, as in this question, you've been given the order in course per order, you've been given the carry-in course. What it means is that you now need to find the EOQ. And the question is, okay, how do you actually go about finding the EOQ when you do not have a set demand? Right. Now, using probabilities is actually the use of probability, when doing EOQ calculation, okay, is really inconsistent with the basic assumptions of the EOQ, which is that demand is constant and known with certainty. Because the fact that you are using the probabilities here, as mentioned, the company is uncertain. But questions may do that, and what you may have to do is to calculate the expected value of the demand and simply use that in the EOQ model. Yes? So now it will become 2 COD, 2 by the ordering cost per order, which is $50, times 94,000 over the holding cost per unit $3, take the square root, and whatever that works up to be, okay, will, you know, give you the economic order quantity. All right. So let me just show you this workings quickly. I just do it on the whiteboard and just copy this, paste it on my whiteboard. Let's enlarge it a bit. Yeah. So what we're actually looking at is remember the formula. Okay. This obviously would be 2. The ordering cost per order is $50, and annual demand we are using the expected value. That is divided by $3, and you take the square root of it all. Okay. Pull up our calculator here. So 2, it's actually up here, times 50 times 94, okay, is equal to, and then divided by 3, okay, 31,333, and we take the square root. That gives us 1770. Okay. And that's it. So any other calculation that follows from that, for example, find the total holding and ordering cost and whatnot, you'll use that 1770. The issue was the 94. Now there's one other thing you should know. A question can also vary it further. Question might say, for example, well, maybe you've been given the demand. You told the annual demand is, say, 100,000 units. But the company is uncertain about the ordering cost or uncertain about the holding cost. And you've been given probabilities. Now, what you'll do is the same thing as what was done here. You'll apply the probabilities to the item, the value which is uncertain, work out the expected value, and simply plunk that into your EOQ calculation. So for example, if the uncertain part was the ordering cost, and you worked it up, three different ordering cost probabilities and got a value of say 52, well, then you'll use that. If the holding cost was the uncertain, put down the three values, the probabilities, work it up, and assuming it works to say 250, well, you use that. Okay. But as I said, the mere application of the EOQ is based on the assumptions that relate to the EOQ. And one of those assumptions is that demand is constant and known with certainty. Therefore, the introduction of probabilities would tend to be opposed or inconsistent with the use of the economic order quantity formula. Okay. All right then. So let's move on. Now, as I said, okay, please ensure that you read through the handout, the remainder of it on just in time, as well as the newsletter article at the end. And at this point, what I'd like to do is to go straight into the other element of working capital, which is receivables. All right, so let me just pull up that handout for you. Okay, where is it? Right. So we've got our main handout here. And then we've got our questions and answers handout. Should be another one. Hang on a sec. Okay, so this is our handout, receivables management. And just a few preliminary issues. We've been looking at, or we are looking at the different elements of working capital. Now, we looked at working capital, some of the general issues, such as overtrading and some of the liquidity ratios and some of the basic working capital ratios like days cash on hand and the inventory holding period, the debtors holding period, inventory turnover, debtors turnover, creditors holding period, creditors turnover, the conversion cycle, as well as the cash conversion cycle, you know, those things. And then in the last class and part of today's class, we started looking at the different elements of working capital and completed an examination of inventory management. Now, working on the list, we've got debtors management, receivables. Then after this, we've got cash management, and then the management of trade creditors. So just as how there are specific ratios which can be applied and specific calculations which can be applied when working the inventory management, when doing inventory management. Similarly, for debtors, okay, there are calculations, or there are quite a bit actually. In fact, I would say there are probably more calculations. See, debtors is not a straightforward area as inventory. What makes inventory straightforward for you is that you're not required to know how to deal with uncertainty models, just your basic certainty model, which is the EOQ. And apart from that, of course, you need to know the other things, such as the ratios, the calculations, just-in-time systems, and you know, the stuff which we went through, which really I think you would agree isn't all that much. Now with receivables, on the other hand, you have to know all the calculations. There are quite a few ratios that you need to know and learn and remember and know how to apply. Then there's a fair amount of theory as well that you also need to know about. Okay, you know, so there's really more to it, and the way the examiner can bring the questions can be a bit more varied than the typical inventory management questions. So what have we got here? Okay, managing debtors, of course, debtors receivable, same thing, is a key aspect of working capital management. The objectives of accounts receivable management are to ascertain the optimum level of trade credit to offer customers and to manage that credit and to balance the twin objectives of liquidity and profitability. Now, again, we come back to this idea of liquidity and profitability. And so our receivable management, as you saw there, okay, once again, it's the balance between objectives of liquidity and profitability. Now, the question is though, with receivables management, what does liquidity and profitability mean? I mean, students often relate to the twin concepts of profitability and liquidity with cash. Say, well, we can understand that. But how does that relate to debtors? Okay, let me just show you something here. Okay, so we have management of debtors. Liquidity, profitability. Now, if we were looking at cash and a company keeps too much cash on hand, which means that it has the liquidity, but the problem is keeping too much cash on hand may be giving up the opportunity to earn a return on some of those funds. So it has the liquidity, but its profitability can be adversely affected. If it holds too little cash, the liquidity would be adversely affected, but the profitability would be favorably affected, put it that way. For inventory, pretty much the same thing happens, except we think stock rather than cash. Meaning if the business has a lot of stock, it has the liquidity as far as stock is concerned, meaning it can satisfy customer demands and whatnot. But too much stock gives rise to additional holding costs. Now, of course, at the same time, being able to satisfy customers' demand would mean sales would be generated, your profits would go up. But just trying to, you know, get this point across about liquidity and profitability and the effect on both. Okay, too much stock would mean additional holding costs. Too little stock, liquidity suffers. Your company runs the risk of stock outs, but at least the holding cost would be less. So, you know. Now, as far as debtors go, what happens if a company has a lot of debtors? A lot of debtors, okay, a high receivables balance, okay, would mean that the company obviously is doing something. In other words, is generating sales then. Okay, so many credit customers. Okay, means okay, lots of sales. Right. As far as profitability goes, though, okay, um, sales will go up, obviously, but okay, there is the risk of bad debts, okay, um, high debtors payment periods, okay, increased admin costs, and there may be others. So many credit customers means increase in the debtors balance on the balance sheet, but although that should see itself in an increased revenue, sales revenue, which would mean profit should go up, then there's always this other side to risk of bad debts, high debtors payment periods. High debtors payment periods means that the company, it takes longer for cash to come back to the company. And remember, we saw when we looked at the cash conversion cycle, to calculate the cash conversion cycle, we add inventory days plus debtors days less creditors days. And ideally, we want to see a small figure for the cash conversion cycle, meaning it takes a short time for cash to come back to the company. If you think of it in a circular motion. Now, if debtors payment period goes up, obviously it means the cash conversion cycle period is also going to increase. And obviously that's not good. The other way to look at this is if a company had a choice, they would prefer not to give any credits at all. So let's assume the norm in the industry is no credit. Okay. Then it means that there will be no credit customers, obviously. So liquidity, as far as the amount, would be zero. And profitability, there'll be no risk of bad debts, no high debtors payment period, no increased admin costs, and so forth. But in most cases, companies have to live with it, especially if that's the norm in the industry. The only question is, okay, how much credit are we willing to extend to our customers, and therefore, how many credit customers, okay, are we willing to tolerate? Now, I say tolerate because, as I mentioned earlier, a company left up to its own, okay, would probably prefer not to have any. But it says, okay, you know what, we need to live with it. So if we've got to generate a lot of our revenue through credit sales, we need to ensure, therefore, that receivables are properly managed. And that's important. See, remember I showed you when I introduced working capital. If you were to look at the calculation of working capital, okay, so working capital, okay, calculation, right? We say it's current assets less current liabilities. And we prefer to have a high figure. So if I, on this side, current assets total 900,000, current liabilities, okay, total 200,000. So 700 is our WC, working capital, okay. On the other hand, if I, on this side, okay, I have current assets 500,000, current liabilities same 200,000. Our working capital is 3. And if you were to ask the average Joe, which is better, they'd probably say the 700. Why? Oh, because current assets have exceeded current liabilities by a whopping 700,000. And that means that we are in a comfortable position. If we got to pay our current liabilities tomorrow, we can easily do that. Oh, really? Can you? Where are you going to get the money from? So, oh, but we have current assets of 900,000. Where are you going to get the money from? So then you take a look at your current assets and you realize that it looks like this. Okay. See, inventory is, say, 200. Debtors, okay, is, say, 600. And cash is the 100. And that's the 9. Okay. So, all right. So then you're saying, but you said that you can pay off your creditors, but you've only got 100,000 in cash. And can you realize your inventory overnight? We saw that inventory is the least liquid current asset, especially if a fair bit of your inventory there is made up of old, obsolete, slow-moving stuff. What about your debtors? Yeah, of course. Hold on, I think a 0 is missing here. You can call up your debtors and say, look, I need you to pay up now. Well, how many of them would actually pay up now? Okay. Especially if they're within their payment periods. And then if you call up those who have overstepped their limits, because you would normally have a certain amount of debtors there. If you give them 30 days, they probably want to 60 days, some of them even 90 days. Don't expect to get money from them immediately. So as I mentioned to you, you need to be very careful as a FM student, as opposed to the man in the street, as to what exactly and how you interpret a big figure for working capital. If you were to look at this one here, current assets, on the other hand, okay, same business, but probably it has decided to adopt a different working capital management strategy. And let me just shift it across here a bit. So now we've got, okay, inventory, say 100, and debtors 100, and cash, the balance, which is 3. Now, okay, now you can say, well, I have $300,000 in cash there. I can easily pay my liabilities. But that is just 100,000. Which means then that you are certainly in a more stable position over here, liquidity-wise, than on the other side. The point is, okay, having a high figure for debtors, whilst it will have the effect of increasing your working capital, is not necessarily a good thing, especially when there's an apparent imbalance between your debtors and your creditors. See over here, remember we said that a company would normally finance, okay, initially its current assets through current liabilities, and what is left over will be financed through long-term liabilities. Now this company is only financing $200,000 on the left-hand side of its current assets with current liabilities, and the rest with long-term. Also, creditors are only willing to grant $200,000 worth of credit to this company, whereas the company is willing to grant $600,000 worth of credit to its customers. That's not a good imbalance at all. Over here, on the other hand, this company is making use of its creditors because it has only extended $100,000 worth of credit to its own customers, okay? Whereas it has generated $200,000 worth of credit purchases. and we are assuming that $200,000 in either situation, left or right, was not or is not as a result of the company taking too long to pay its debts. It is as a result of suppliers just willing to extend the credit to the customers, and the customers are taking to the company, sorry, and the company is in fact taking advantage of it, but is paying its creditors on time. You see, so it's not as straightforward as one may think, as how you may have been taught in your level 1, as how you may have been taught prior to learning about financial management as a course. So just reading on, why is it important to manage receivables? Allowing credit to customers will encourage sales. Yes, we agree. Or at least the absence of the availability of credit will encourage customers to seek an alternative supplier, offering more favorable terms. And that's not good, is it? Nope. That's why I made the statement in the past. A company may have no choice but to offer credit. They will tend to lose more if they don't than if they do, because if there are alternative suppliers willing to do it, customers will go there. Allowing too much credit or not managing a credit policy carefully enough could result in irrecoverable debts. And this has to be written off. This represents a loss of income to the company, affecting both profitability and cash flow. So we've got this little balancing act. Liquidity, collecting sales receipts as quickly as possible to reduce the cost of financing the receivable balance. Profitability, extending credit period to customers to encourage additional sales. So I showed you it on the diagram on the whiteboard, okay, in one way, and now you see it in another way, with liquidity meaning collecting receipts as quickly as possible. So the cash is coming in from the customers. But on the other hand, we have to extend credit period to customers to encourage additional sales. What that shows you then is, if you wish to have a proper balance, you don't just aim to have a proper balance, but you aim to manage the balance as well. So if you intend to extend credit periods to encourage customers to buy more, then guess what? You also have, the company must also have a proper debtors management process in place so as to collect monies back from sales as quickly as possible. As you saw in the illustration on the whiteboard just now, having a big figure for debtors does not necessarily mean that the company is doing well. It can simply mean that customers are taking very long to pay because of poor debtors management, and a lot of that 700,000 on the left-hand side may be debts which the company may not actually be able to recover because it's gone over 90 days, 120 days, things like that, all because of poor debtors management. Credit policy. As part of the management of receivables, a company must establish a credit policy. This policy will be influenced by demand for the company's products, competitors' terms, risk of irrecoverable debts, financing costs, cost of credit control. The elements to be considered include establishing terms of trade, such as period of credit offered and early settlement discount, deciding whether to charge interest on overdue accounts, determining procedures to be followed when granting credit to new customers, establishing procedures to be followed when accounts become overdue. So what we've got here is this policy, the accounts receivables policy, the credit policy, will be influenced by these things, because obviously if there's high demand for the company's products, it means that the company would probably want to give customers the opportunity to buy the product and extend some credit to them. The company must also look at what competitors are offering. The company must take into account that if it's a bit too lenient, okay, the risk of irrecoverable debts would increase. The company also needs to consider that given trade credit to customers means that it has to finance more receivables at any time, meaning that the company may be using its overdraft because the cash isn't coming in as quickly. You see? Remember, we said that, look, if the figure for current assets 500,000 and for current liabilities 200,000, that means 200,000 of current liabilities, okay, are currently financing 200,000 of current assets, and the remaining 300,000 must be financed through other sources, right? Now let's assume the company has an overdraft limit of 150,000 and is currently using 100,000 of that. Unlike trade creditors, which is normally free, unless maybe the company oversteps, in which case there might be a penalty. Overdraft is not free. Company has to pay interest on its overdraft. And also, let us assume that the remainder, as we normally do assume, is being financed through long-term sources. That is certainly not free. And this is why I mentioned financing costs. As long as there's a debtors figure on the balance sheet, there will be a financing cost. And of course, one of the things we will be looking at in this lecture, this handout, is how to go about calculating the financing costs associated with debtors. In the first lecture on working capital, in the spreadsheet, you may recall in an area which I highlighted, I think it was in yellow, I said all of the assets of the firm must be financed in some way. I said generally we use the matching concept in that current assets will be financed through current liabilities and long-term assets through long-term sources. And then I said, however, it is the norm to finance part of the current assets through long-term sources. And in fact, as long as we have a positive figure for working capital, that is what is happening. But it is not the norm to finance either part or all of the firm's long-term assets, non-current then, through current liabilities. Because if you do that, what you'll be doing is using up valuable resources, okay, which are meant to finance the firm's current assets on a day-to-day basis. I think I'd use the example, but in relation to overtrading of this supermarket, which I was acquainted with in the past. So these are the influences on the credit policy, and these are the elements to be considered, okay, in establishing the credit policy and making decisions. Why is it important to have a credit policy? A firm must establish a credit policy for credit, a policy for credit terms. Ideally, the firm would want to obtain cash with each order delivered, but that is impossible unless substantial settlement discounts are offered as an inducement. It must be recognized that credit terms are part of the firm marketing policy. If the trade or industry has adopted a common practice, then it is probably wise to keep in step with it. Assessing creditworthiness to minimize the risk of irrecoverable debts occurring, a company should investigate the creditworthiness of all new customers immediately and should continue to assess existing customers periodically. So note, investigating creditworthiness. you may ask for references. Now, if you assume here, as we normally would, it's a retailer perhaps selling goods to its customers. And in this particular industry, it's the norm to give credit, right? Now, that is the assumption that we would normally make. But remember, it can equally apply to a wholesaler selling to a retailer, where the wholesaler would give the retailer a certain amount of days to pay. Now, in that case, of course, it means the wholesaler must also get credit from its supplier, who might be, or which might be the distributor. So it can work either way. The important thing is this: whether we are looking at the relationship between a supplier and a wholesaler, and then a wholesaler and a retailer, or between a wholesaler and a retailer, and then the retailer to its retail customers. Okay. The fact is, there will be, or there can be, usually there will be, credit being accepted from the party from whom goods have been purchased at the beginning. So, for example, if it's the retailer customer supplier relationship, retailer would get some credit from its suppliers, and then the retailer might be in a position to offer credit, if that is the norm in the industry, to its customers. Okay. Of course, the ideal thing is to receive credit from your suppliers, but not have to give credit, because that would certainly shorten your cash conversion cycle, and the cash would come back to the company a lot more quickly. So, assessing credit worthiness, okay, information for credit worthiness may come from a variety of sources, such as bank references, trade references, competitors, published information, and so forth. Credit limits. Credit limits should be set for each customer to reflect the amount of credit available and the length of time allowed. A ledger account should be set up and monitored for each customer. If you remember your account in books of prime entry, okay, you would have, as one of the books of prime entry, you'll have your sales day book, which records all credit sales. And then, of course, you will have the general or nominal ledger. And at intervals, sales would be posted to the general ledger. Not every day. The day book, on the other hand, contains transactions which occur every day. But although the name of the debtors account in the general ledger may be called receivables control or debtors control, whatever, and that actually is part of the double entry, so that when a debtors figure is posted from the sales day book, okay, to the general ledger, you would see debit receivables and credit sales. That's it. Right. So debit receivables, credit sales. But in addition, the company has to maintain a memorandum ledger, a memorandum debtors ledger. And the memorandum debtors ledger, there will be a single account held for each customer, each credit customer. And all movements related to that customer must be recorded in that memorandum account. So if sales have been purchased today, if goods have been purchased today by customer X, then that must be reflected in the memorandum ledger. If customer X comes in and buys some more goods on credit, that must be reflected as well. If customer X comes and pays off his balance, that would also be reflected. So the memorandum ledger, okay, there will be one maintained, not necessarily a whole one, but maybe a page okay, set up, whether it's electronic or manual, for each customer. Okay. Invoicing and collecting overdue debts. A credit period may begin, a credit period only begins once an invoice is received. So prompt invoicing is essential. If debts can go overdue, the risk of default increases. Yes, see, the longer customers take to pay, the greater the chance that those debts would go back. Therefore, a system of follow-up procedures, okay, is required. Most companies would typically follow a collection procedure. This reminder letter, this is, following up on the debt. Reminder letter, telephone calls, withholding supplies, debt collectors, legal action. Now, I guess, recognizing the impact of computers and computer technology, that may be modified a bit. Reminder letters, especially where the mail, okay, is a bit unreliable, may not be a good idea. But email is a lot more efficient and reliable than reminders, because the company can in fact know when customers have read their emails. A simple messaging system like WhatsApp, okay, might also be more reliable than the mail itself. If you send out the reminder letter through WhatsApp, you know when the customer has received it. Or, as I said, email can be used. Telephone calls, well, that's still there, of course. Technology has got rid of it. Withholding supplies. So after reminder letter, after telephone calls, if nothing doing, then you will withhold supplies. And then the step after that is to hire debt collectors and then legal action. Now, hopefully, many companies don't actually need to go to the full extent, but at least this is the order. Okay, so I have here data management ratios, see Excel handout. Now let's take a look and see some of these ratios. Remember, I told you that just as when we look at inventory management, okay, there are ratios related to debtors as well. And whilst we did come across a couple of them with the general working capital ratios, there are some more. Remember, the purpose of the data management ratios, okay, the ratios may act as diagnostics, but okay, the ratios also enable the company to track the, for example, the amount of debtors and whether debtors are in fact paying, the length of time debtors are actually taken to pay versus what they should be taken to pay. But most ratios, and debtors included, are diagnostic tools. Based on what has been diagnosed through the use of the debtors, then the relevant action can be taken. Okay, so we've got here trade data management ratios. Let me just see if I have anything. Yes, I have some useful stuff here. This is class material that we'll be going through. The first ratio, which you met before when we looked at the general working capital ratios, is the trade data, the average collection period, also known as the debtors holding period ratio, which simply represents, okay, the amount of time customers take to pay. Now, notice a company may give customers 30 days credit, but if customers are taking 45 days, we would like to know about the 45 days, not the 30. So we always do our calculation based on the actual time, not on the policy time. And again, as we saw before, to calculate the average collection period or the debtors holding period or debtors days, if you prefer, simply take average debtors over credit sale by 365. Now, just show you something here. So we have one, debtors holding period. We also have average collection period. I was going to copy and paste it, but I may as well just write it out. Okay. Or so debtors holding period or the average collection period or debtors days etc. Now, what I mean by etc. is, see, the formula looks like this, okay? Average debtors over credit sales times 365. Now, that is the debtors holding period in days. 365. But equally, you may be asked to calculate the collection period or the holding period in months, days, weeks. So it may be 365, or it may be 12, or it may be 52. Okay, you can do it. But usually the question would leave you a no doubt. Right. So, looking at the handout here, sorry. So this is the collection period. And the turnover, of course, debtors turnover is another way of expressing it. Ideally, we would like to see a higher figure rather than a lower one. Yeah. For the turnover, that is. Now, the turnover is credit sales over receivables balance. Okay. So this turnover here, just like this. Right. So this is our turnover, credit sales divided by receivables. you. Right. High figure for turnover, which means that the customers are paying on time, and at any given point in time, there isn't a big balance for customers taking very long to pay. Example, the Uber company had $400,000 in cash sales, in credit sales, sorry, for the year ended, and its receivables averaged 40. Now, it is important that you recognize in a question the fact that you are using credit sales. You may be doing a question, and the question says 60% of the sales are on credit, therefore the remainder is on cash. You always use the credit sales when doing this calculation, because that's what this is about. Remember, the name of the topic is accounts receivable management. Average collection period, and again, this is a formula we met before. Okay, 40 over 400,000 by 365. Now, what is the 400,000? That's this. And the 40,000 is the receivables, 36.5. Right. So 40,000 over 400 by 365, and AR turnover, credit sales over AR balance, 10. This is normally witnessed 10 times. 365 over this, come back to the same thing. All right. And then there's this ratio called the bad debt loss ratio. This is the proportion of total receivables account not paid. Now, it obviously has to be the proportion of total receivables. Don't make a mistake and say, this is the proportion of total sales not paid. The reason why that would be incorrect is because it's not the entire, okay, receivables, which includes customers from all over the place in different countries. So the proportion of total not paid, an increase in the ratio increases the cost of extended bad debts. Well, I mean, look at this formula here. Bad debt expenses over credit sale by 100. That's how we actually do it. For the Uber company with bad debts of 12,000, 12 over 40. Right. Take a look at this. Bad debt expenses, 12. Okay. For the Uber company, well, not there, but just put in a team. Over credit sales, 400. Now, there's something that you need to recognize. Let us assume that the firm decides to grant additional credit. In other words, then, make it easier for customers to get credit by probably relaxing the credit standards. And it just so happens that sales double, going from 4 to 8. This does not necessarily mean, okay, that the bad debt loss ratio will go from 3 to 6. But what we can say though is that let us assume that it was 3% right now. Okay, the bad debt loss ratio. and then it goes to 6% with the relaxation of the credit. But the total sales, okay, it goes up, you know, to 800,000 or whatever, it doubles. Now, it means that if the bad debt goes to 6%, okay, that might be an overall calculation done. In other words, then we take our 400,000, you know, 12 over 400,000 by 100% is 6, okay? Sorry, is 3, what we have there. Or in other words, 400,000 times 3% is 12,000. Now, if this goes to 6%, and that figure in the denominator goes to 8%, 8 times 8, the 800,000 times 3 will be 24,000 going in the numerator. And we may assume, well, it goes up to 6, and that must be because the bad debts have gone up, okay? Doubled in this case from 12 to 24. Now that may be so, but you need to understand the reason why the bad debt went up. The existing customers, okay, may not be the ones responsible for standing up that bad debt loss ratio to 6%. Because our existing customers, they take advantage of any discount offered to them, and they pay. And from the existing batch of customers, there's a 3% bad debt loss ratio. So the existing customers have been taken care of already. And what that means, therefore, is that the reason why that went to 6% is mainly because of the incremental new customers that come in. Now, why should new customers contribute to an increase in the bad debt loss ratio? Possibly because one of the reasons why they were never new customers before is because the company had its standard credit policy in place, and certain criteria must be satisfied, and they never satisfy the criteria. But now that the company has relaxed its position, okay, they will satisfy the criteria because the company quite simply says, well, come and buy credit. But the majority, or the main reason for that increase from 3% to 6% will be the new customers who were not previously credit worthy. And the only reason why they've got in now is because the company has relaxed its credit standards. And then investment in accounts receivables. Now, this represents at any point the amount of receivables balance that the company has. It's trade receivables that you normally see on the balance sheet. Now, that's not difficult to find, okay? Average daily credit sales by the daily collection period. This is the investment in receivables. So, for example, for the Rover company, the investment in receivables is 400,000 divided by 365 times 36.5, 40,000. Remember in the Rover company before we had this. Okay, this is what we had before. 36, right. So if 400,000 or 40,000, okay, over 400,000 times 365 is 36.5, then clearly 400,000 divided by 365 times 36.5, okay, would give us the debtors figure, 40,000. Now, this is the investment in receivables. So you can write it like this: 400,000 over 365 times 36.5 days. Okay. Or you will put it as 36.5 over 365 times 400,000, same thing. And the way in which it's written here is probably the better way to do it. I'll tell you why. See, if you divide 400,000 by 365, what you're getting is a daily equivalent figure, okay, of the credit sales. In other words, on average, every day we sell on credit, whatever that comes to. And then if we multiply that by 36.5, it means since this is the daily credit sales, and this is the period of time customers are taken, if you multiply the daily credit sale by the time they are taken, okay, you will get an average as to what the debtors figure is. You know, the average debtors figure. So really it's the same formula, just turning things around. And the last ratio, which stems really from this one, is the cost of investment. Now, we didn't meet this before, but this is a very important ratio. What this shows, or what this actually brings out, is something I mentioned a while back today, but also it was presented in the spreadsheet, the first lecture on working capital management, the one which I said earlier was in yellow, okay? All of the assets of the firm must be financed in some way. Generally, the current liabilities assist in financing the current asset, and if there's a positive figure for working capital, it means that the remainder must be financed through long-term sources. If a company therefore has debtors on its balance sheet, in keeping with the statement, all assets must be financed in some way, and current assets generally through current liabilities, but the remainder through long-term liabilities. It means that the higher the investment in receivables on the balance sheet, the higher would be the cost of financing those receivables, because the company, if it's using its trade creditors alone, then that's fine, there's no cost there. But the company may have no choice but to also resort to some other form of borrowing or using its overdraft. Now, those are still short-term sources of finance, so the overdraft will come under current liabilities. But, and of course, that's not free. But if the overdraft has been utilized, then the remainder will be financed through long-term sources. So you need to know what that cost is. How do we reflect the cost of the investment in receivables? Investment in AR times the opportunity cost of the investment. And that's how we calculate the cost of the investment in receivables. We take the receivables figure and multiply it by the cost per annum. So this is the investment in receivables. So we've looked at, now we wouldn't look at this one as yet because we're not going to be using this as yet. Later on we look at it. We've looked at the main ratios, and what is left for us now is to see how they actually work and the rationale behind the use of them and so forth. Oh. Where did my debtors? Oh, here it is. Not worried there a bit. So in the next class, what we'll be doing firstly, before getting into factoring and invoice discounting, I'll be showing you how the debtors policies actually work. And that's where this comes in. Actually, yeah, this, see. Okay, it's not here, but it's here. Yeah. These illustrations. See, these three illustrations actually bring out the use of the policies. And In addition to further explaining the policies, the debtors policies, it gives me the opportunity to show you how to use the ratios as well. Okay, right then. So that's it for today's class. Look out for the recording as usual and the handles. I can't recall if I posted them up as yet in the classroom. If not, I will do so. So good day to all.